Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for Thursday, August 1st, 2019. Quite a bit to cover in the markets today. We're starting to obviously see volatility expand. We have certainly have some interesting technical developments worth noting today, some key levels to watch, which I'm going to point out. And in this video, we'll walk through step by step how we were, at least I was, and people on the site able to pretty much identify these levels today, very key levels. In other words, the big inflection points. So let me just try to recap today. And if I had to tell it in 30 seconds or less, the story is we've been building these negative divergences for months now, many months, just like we were building divergences into the October 2018 highs before the big drop. So the charts have been increasingly bearish, indicating a correction's coming. But just like back then, divergences, trend lines, there was no sell signal. A body in motion stays in motion unless acted upon by an equal but opposite force, and that's what an uptrend is. When you're an uptrend, the equal and opposite force will be selling. It'll be most often triggered by a technical catalyst, which quite often can. Technical catalyst, meaning charts, technicals, is a breakdown. And then quite often, but not always, that will coincide with some type of news-driven event. In other words, because you have the trend going up, and during a strong trend, when everything's fine, the market price action's healthy, market breadth is healthy, there's more buyers and sellers, and importantly, the technicals aren't indicating an imminent correction. What happens is bad news is good news. It's shrugged off, and good news is good news, so you continue up. Finally, it reaches a point where when you have a clearly bullish or bearish pattern, or extreme bullishness or bearishness like down here, it doesn't take much, and then you get the catalyst, and then the reversal comes. So that's what's been happening here. We've been in a slow grind. The momentum has been upwards, and it's the whole nature of a wedge. You have these contracting prices, volatility starts to contract. As I warned recently, volumes taper off. I showed you my sell signals last week, I think it was, on the broad markets. When the average volume hits a certain low point, that's where a lot of these big and the smaller corrections have triggered. So everything was there. We just needed to match to light the fire. And yesterday we had the breakdown and of those trend lines in all the major indexes that I'm watching. That's QQQ, SPY, and even XLK, the tech sector. So yesterday I did say you had to take it with a grain of salt. The breakdown, it was very impulsive. From a technical perspective, it couldn't have looked much better. Big red candle. Two things I like to see on a breakdown, or a breakout on the long side for that matter, if it's a bullish pattern, is I like to see an impulsive move, and that's certainly impulsive. A red candle that dwarfs any candles that we've had for months now, as well as large volume expansion. And that's exactly what you want to see. That's what we got. So I said, there were a couple things that still are, or were and are, holding us back from a more powerful sell signal, and that's the fact that the SPY had that key breakout point at 294. It was the previous highs. There's a high even to the left of the chart. You can see right there. Again, all covered in recent videos. And so that was a level that right here was broken out. So we're still above that. In fact, call it coincidence or not, we hit 294 almost to the penny today. I think it was within 3 cents from the lows. It might have went to 290. What I'll tell you right now. Hold on, I have to make that chart go away for a second. Low on SPY was 293.96. Close enough for government work, my friends. So that was nice, because that's a key support level. I was able to reverse shorts, flipped to a long, play a bounce, and got back into shorts right after that, and went home short again. And that's just active trading stuff. So let's again look at everything else. Nope, not the charts I wanted to look at, but we'll look at QQQ. Same story. QQQ broke down yesterday impulsively, had a back test. It's hard to make it out here. I'll get to an update. I did a midday update video, and we were actually back testing right at that time. And what I'm going to do in this video is take you down all the way to the 1-minute charts. These are charts I posted not after the fact, as always in advance, real-time levels to watch. to when we had that rally today, where to enter a short if you were inclined, if you were the same mindset I was, that the back test today was an objective place to add. It's easy because objective doesn't mean high probability. It doesn't mean guaranteed. It just means simply what I just said, objective area. What's not objective is to take a long, or let's say a short position right here in the middle between support and resistance. That's no man's land. I like to, if I'm going to short, I'll do one of two things. I'll short a break of support, or I will short a bounce into resistance. Likewise, when I'm going long, I will go long in one of two ways. I will go long on a breakout, as I did here, or a pullback to support. Well-defined support levels. So that's what happened today. We bounced into resistance, but again, it wasn't just that, because as I said in the video, and I've said this before, one of the hard parts about shorting when you short a bounce into a horizontal price resistance level, say 191.46, let's just say. SPY is a little clearer with that 294. That's not it's actually better defined than this one, but let's just use this for an example. If you're looking on a trade, let's just say this happens next week and then you miss it, or you want to get in, you're already in, you want to add, and you get a kick, you want to know where to add, so you're going to try to short on a kickback of 191.46. That's easy. It's objective. It's nice because you can quantify your stops. You can place an objective stop a little bit above that resistance, allow for a little momentum overshoot, a little stop pop, stop raid. But if you're wrong, if they take it out, they're probably going to run. And so you know exactly how much you're going to lose if your stop is popped. However, when you short a backtest of a trend line, the problem with trend line backtests, trend lines, unlike price resistance levels and support levels, these are static. Trend lines are dynamic, meaning that they have a positive or negative slope. Therefore, prices come in at higher and higher levels every day, every minute, actually. I've seen securities that backtest once, one and done, and then move down after a breakdown. And I've seen other things that backtest for days, weeks, sometimes even months before the reversal sets in. So at that point, in other words, then you have to look for some other levels, or just pick a set percentage. If you take that backtest, if you short it, you have a stop somewhat above. If you don't have a resistance level to set your stop above, or some other metric you're using, you can just pick 1, 2, 3, 4%, whatever, and that'll also be relative to your target. Anyone's stop, I like to use a 3 to 1 or better risk reward ratio, meaning I'll risk $1 for $3 of profit that I'm shooting for. And so therefore, if I have a 12% price target on a short trade, I'll allow myself a 4% stop loss, roughly, and then I'll take that number and I'll try to align it with the technical levels. All right, so enough on that. We're going to get to the entries in a second here. Finally, so that's QQQ. Just wanted to point that out and throw in those extra tidbits if that helps. So there's the initial breakdown, kickback rally, and a very impulsive rejection. So again, yesterday we had the check marks with the breakdown. A little suspect because of the FOMC meeting. Today, certainly, yes, Trump tweeted out. Yes, that was the catalyst at the same time, but coincidence or not, I've been doing this many, many years, and I cannot even tell you how many times I've seen a stock break down or break out of a chart pattern, or break down below support, break out above resistance, break a trend line, or reverse off a back test, and it coincided with a news headline. Sometimes it does, sometimes it doesn't. The two are interrelated in a way that I can't even explain, but I can tell you that it's not just mere random coincidence. That's sometimes it can be, but usually it's not. And then finally, let's get to XLK, and then we'll get to the other stuff I wanted to show you. Just a beautiful, beautiful example. Like I said, and I've been saying it for a while now. Until tech breaks, the market doesn't break. You want to know when to short the market? You wait till technology breaks, because tech is the largest sector in the S&P 500, by far the largest in the NASDAQ 100. That was a big red candle, pretty powerful sell signal yesterday. We came up and made a perfect back test, followed by a very impulsive. Look at the volume down here. So there it is, confirming. Little work to be done. Just like SPY has that 294 support, tech has some support there. It's above the all the major markets had a major reaction high here in late April. So those are the levels when I say there's a little more work to be done. and I'll maintain what I said yesterday. I thought that was an objective time to take a starter short. Today was an objective time to add to that short, kind of build it, because the bearish case is building. We got the back test, and if we continue down tomorrow, we can, I think soon you could be at a what I call full short position. I said this to members in the video earlier today, and it warrants repeating. A full short position on the market or anything does not mean 100% of my money in the market. I am a very, I believe, and big time. I'm a big proponent of asset allocation. And so, if you're going to short the market or go long for that matter in your trading account, it should be a piece of the pie. And how much you have in the stock market is up to you. It might be 50%, 30, 10, 5, but you should have other pieces of that pie, silver, gold, individual stocks that might have very little correlation with the stock market. Somebody asked me today about a trade idea, and it's a small biotech stock that could care less what the market's doing. It was up today because it goes up and down on its own, because it's not a component of the S&P 500 or the NASDAQ 100 or even the, I don't even believe it's in the small cap index. So when I say full position, it's whatever amount that you've determined you're going to allocate. Okay, I'm going to try to swing the market down. I think we're going to get a 5, 8, 10% correction, whatever your number is. So, out of my portfolio, say you have 100,000, you might say, okay, I'll do 10, 20,000 into, I could sit here and talk on this all day. It depends. If you're going to go with QQQ or SPY, well, that's an ETF that holds 100 to 500 different stocks. You're diversified there. But if you're going to short just Apple or just XYZ company, you might not want to put 20,000 or 1/5 of your portfolio in a single stock, because if that stock gaps against you on bad news, earnings, anything else, individual stocks can and often do gap double digits, 5, 10% or more, depending on the sector. The stock market's not going to gap 10% against your position, not 500 stocks at once, because even if the SPY opens down big tomorrow or up big tomorrow, you've got utility stocks that are going to balance out whatever the tech stocks are doing, et cetera, et cetera. So keep that in mind with your position sizing. All right, back on topic here. So that's it. And then to look at the 60-minute chart, again, it from a technical perspective, it just couldn't look any better. There's your price channel on XLK. We just looked at the daily. This is just zooming down to the 60-minute chart so you can see how well the technicals are playing out. There's that $80 support right there, pretty well defined. Kissed that yesterday. Boom, bounce back on perfect back test, right back to support. So I'm giving you levels to watch tomorrow. So that support's been tested twice recently, several times back here. That helps to validate it. The more tags you have on a level, the more significant it is. So therefore, just like SPY closed right off that 294 level, we basically need to undercut today's lows. I mentioned this in the trading room to somebody who was wondering. They had a nice day, very profitable on their shorts, and were wondering, do I take them home? Do I close out now, book profits? And I said it depends on what really what your trading plan is, where you think the market's going. But I said the easy money, the easy trade would be to buy the dip, buy support like the masses. Where the hard trade is, but the odds, if you're right, even if the odds of a going home short, because if you went home short, you went home just above support. TA 101 says you don't short. Especially you don't enter a short position just above support. You wait for a break of support. Just like you don't go long a stock just below resistance, you wait till the resistance taken out. So the kind of similar holds true when you have positions. If you go home short right on support, and that support holds, the market will then gap up or bounce up tomorrow, rally up. However, so although the odds of being stopped out or giving back some of your profits tomorrow on a gap up are pretty good, the reward, the analogy I use is like betting the horses. You bet the sure winner, the favorite to win, you get almost nothing back. You place the favored horse to win a straight up bet. The odds are very low. You're going to get your money back and hardly anything. Whereas if you bet either the long shot or one of the horses that aren't favored, you're going to get several times your money. And that's what I said, it's going home short now could pay off, because if the market happens to gap down tomorrow, what it will do, and Mr. Market loves to do this. Let's go back to SPY here. I just showed you XLK, so you could look at that level there. Okay, so on SPY, for example, I told you the low of the day was just right about 294, literally 4 cents below it. And so it's a well-watched support level. I mean, no offense to anybody, but you'd have to be blind not to see that level looking at a chart. That's just it's just huge. You know, two failures there, a third test, finally a breakout, and so it's pretty clear that was a breakout. So that's a pretty significant well-watched level. So now what will happen is if we gap down, Mr. Market likes to do this. It doesn't like to make it easy for longs or shorts. So while we could open right on 294 tomorrow, that'd be easy. You know, you can go long. You know, if a bull, you can go long at 294 as long as you remain above it with a stop a little below. If you're a bear, you can wait for it to break down and then short. But that's too easy. Market doesn't do easy, not very often. So what it's likely to do tomorrow is either gap down significantly or gap up. Gapping up would burn those that went home short. They'd be trapped. They'd lose at the gap and then have two choices: hope for another pullback to 294, whatever, to get out, or cover. Well, maybe if the market, and you know how the market rips at the open when the big boys come onto the field, you know, futures will kind of muddle around in the morning at 9:30. If you trade like I do and you watch, that's when you usually get a sharp rip or dip. So what I favor is a gap down tomorrow, and that does one of two things. It denies the what I call wannabe shorts. Those that want to be short, you know, see everything that's going on, been wanting to short, been burned too much, but they're wanting to see a more solid sell signal. So that would gap down and deny them an objective entry. You know, let's just say we gap down 2%. Most shorts wouldn't want to chase a 2% gap down. They'd say, "Oh, wait for a kickback to 294." But then what the market will probably do, in my opinion, is just keep going lower, not let them in. Likewise, because the market is cruel, it would trap longs. Those that went home said, okay, you know what, yeah, I see the breakdown there, but 294 is a big support. This is a back test, which it's all it is right now. Simply today was a back test of that key 294 support level, and successful because it held. We didn't really bounce off it. So what it could do if it gaps down tomorrow 2%, it will deny longs that objective exit that they want. You know, those that had a stop just below 294, because remember, stop loss orders are useless against a gap. A stop loss order will be bypassed and converts into a market order if your stop price, if you have a stop at say 290, let's say 293.90, and the market gaps down tomorrow to 290, what happens is your stop loss order stays open. It does not fill. I'm sorry, I said that wrong. Stop loss order immediately converts to a market order and will fill at the whatever the price is at the time. Whereas a stop limit order, so you say, okay, I'm not going to use that, Randy, because if the market has a big gap down and shoots up, I'm going to be filled at a horrible opening price. And that's true with a stop loss order. The other ones are stop limit orders that say, I want to stop limit at 293.90, means if SPY hits 293.90, sell me at 293.90, but do not sell me at a less favorable price than that. Don't sell me at 293.89. Don't sell me at 290. The order will not fill. So what happens to those traders is they watch what seemingly well-placed stop do nothing while their position just continues to lose. And that's the whole dynamic, that's the whole nature of these sell-offs and why you start to see, and that's why I say I love shorting, because stocks tend to fall a lot faster than they rise, because when you have that uptrend, it's a lopsided trade. You have a lot more bulls and longs than you do shorts, and then the stops start getting hit and selling begets more selling. So anyways, enough on that. Let's just walk through a few things and we'll wrap this up. So you see, basically, to sum it up again, pulse of breakdown, back test. Yeah, there were some techno or news-driven catalysts, but the charts are what they are. Still need to break that 294 with conviction, and you know, the level I just showed you on XLK as well. But now let's take a look at how to trade, or how you could have traded today. Okay, these are all today's posts, starting with this one posted before the market opened. This was just a monster trade. I won't get into it now. The nat gas trade played out perfectly, hit my final target on that gas. You gas reversed today right after the final target was hit, so big money to be made there. And again, more money to be made just on the long side, not even if you reversed at the final target today and then took the short, which was almost, or reversed it down. That was, nat gas and UGAS did more in percentage terms in 2 days than the market's done gains in probably several years or a couple of years. But again, that's, it's a volatile commodity, so it's not an apples to apple comparison. These guys can cut you too if you get in them on the wrong time. But either way, that was we nailed that one. So today started out this morning posting these 60-minute charts. And what I said at the time is these are levels that could be used in several ways. Those bullish could go long on pullbacks to support, blah, blah, blah. Or those that were bearish like I am could use a short entry and on a bounce back to resistance. So these are the levels I gave. Here's SPY. Downtrend line, and I think I covered these in last night's video, at least the ones on SPY. We have a downtrend line off the high, so I showed us going up here. I'll get to why you have different arrows, because there was a minor trend line, uptrend line there that we were watching today that didn't get broken until up here. So until the minor uptrend line broke, you wouldn't reverse. So we could have reversed at any of these resistance levels, but that's where I had us going up to max target. And I said anything above that 301.29 would be bullish, because this is where the market should have and did stop today. QQQ, same thing, downtrend line, bullish if they pop that, but this was my preferred scenario. Made clear, come up, reverse anywhere from there to about up to that trend line. And again, futures tell me they paint a much better picture, because futures trade around the clock, and you can pick up a lot of different levels, trend lines, uptrend lines, downtrend lines, horizontal price and support and resistance levels that you don't see because you have the round the clock trading on those. So there's the uptrend line on ES, so you can see right there a little wedge type pattern, flag type pattern with an uptrend line. So that was my uppermost bounce target. 307.66 was price resistance with the downtrend line just above there. And then same thing on NQ. There's your trend line right there, your uptrend line, and there's the downtrend line, and 79.20 with a max upside target there about 801.50 or so, and anything much above that. Now this is probably to me the most important level, because number one, I'm an NQ trader. Why? Because as I always say, you're going to trade the markets. You're either going to get the call right or not. And if you're going to get the call right, you get more bang for your buck. The reversal today, the QQQ and the NASDAQ 100 and NQ dropped 3% off the highs today, whereas the S&P 500 only dropped 2.3. They both, big red bars, look the same, but QQQ and NQ will just go up and down more, all things being equal, than the ES. So, and it's also chock full of the names that really control this whole stock market, the big FANG stocks, Apple, Amazon, and so you kind of get a cue in on what those stocks are doing, because as I said, when tech breaks, the market breaks. NQ is tech. I always say the NASDAQ 100 is simply a tech ETF or an index with an Amazon kicker, is what I jokingly refer to it as, because QQQ and XLK mirror each other almost perfectly because of the top weighted components. So there it is. And now let's go to what happened today. Let's look at the chart of NQ. Oh, that's natural gas. See, there's that 230 target, the big reversal of NG. Here it is. There it is. There's that 801.44 level, almost a perfect kiss of that level. Yes, what I call momentum fueled overshoot. When you have a security going vertical like a rocket or straight down, you will more often than not briefly overshoot the level that you are going to stop on. Just like as I showed you a second ago on my natural gas trade, I had 2037 my target from before this thing even broke out. You were going vertical through there, and so you overshot it, and then boom, that was a level that stopped. I mean, technically not, because you overshot, but it was the resistance level, very well defined like that, and then the reversal comes. So that's why you get out there, or you trail stops up if you're going to keep letting it go, and and then you could have reversed it. So back to NQ, same thing. 80, that 80150 target from this morning was laid out. Now you might say, okay, Randy, you showed a few different arrows that we could have broke down earlier. And let's look at ES real quick before I get to that and show you those same targets. I had that 307.66 level, which is really, you know, that's 75. Popped it by just a hair and then reversed. Same thing, momentum fueled overshoot. So okay, where would I have added? Here, here, here. Well, again, there was a trend line there, but what I did for members earlier in the day is put this post, and this was well over 6 hours ago. I haven't updated this yet. This was posted earlier. So wait for it, wait for it, wait for it. ESNQ 1 minute trend line breaks likely to trigger a reversal for the day for a day trading / fade to the rally entry. Ideally, if they occur either after the NQ 60-minute downtrend line or ES 300750 resistance level are kissed. Otherwise, we're likely to get another thrust higher shortly after the breakdown. So I'll show you these charts. So these were the uptrend line. These are the futures today, and this was again posted earlier today when we were still rocking up just before the back test. So these were the trend lines, and those were your triggers. Watch them both, NQ and ES. You could have done this. You don't have a futures chart. You can do it with SPY and QQQ, but these lines show better. That's why I chose ES and NQ. You have, they're cleaner than the lines I have on SPY and QQQ. And so that kept you in the trade, kept you long, or holding off on your shorts until they broke. And that was, again, I showed you the level there. So if we had broken down earlier, what would have happened, in my opinion, is a kickback rally. We would have broke those trend lines and gone back up. Now let's look at where they ended up closing. Let's see. So that would be, that's right here. So this is what I'm showing you. I had to zoom out. Those were 1 minute charts before. Those are the same trend lines that I showed you earlier in the day. There were the breaks. Now, and I often say this too, I look at them both. Even though NQ is my preferred trading proxy, I won't short NQ unless ES confirms and breaks down. So you can see early NQ broke right there. ES held, kept hugging its trend line. Finally, right at the highs of the day, that's where it broke. And now, what made it even better, just like I said in that post, ideally you want to see these trend lines break. You want to take that short, not earlier. If you can wait, because you would have had a kickback, it would have looked, this is what I envisioned, this is what I was referring to. If they broke earlier, we probably would have went up there and then hit those uppermost targets. What would happen is that trend was strong all morning, and right when we back tested on those daily charts, the 60-minute charts, that's when we got a breakdown. It doesn't get any better than that. So what I said earlier in the video, I like to short bounces back into resistance or breaks of trend lines. Well, here I use the intraday, the 1 and 2 minute charts to align with the back test of the trend line. So we had a bounce at resistance followed by that, and you can't really hone down any closer than going down to a 1 minute chart. So that is the, you know, what I call a high probability entry. And then boom, there's the ES dropped 2.3% and the NASDAQ 103%. A single contract of NQ on a 3% drop is good for I don't know, probably $4,000 or $5,000, $4,000 at least. It's, you know, over $4,000 for just one contract. And again, it depends on your account size, but you know, if it's day trade, and that's what I listed that in the trading room as a day trading op, because you could then get in, you get that short, you short it at the back test. You could also, and I had intended it to also be, because I did the video earlier, an objective short for a swing trade. And either one, whether you're swing trade and you're holding on, or you did the day trade, you short there, and then you just trail your stops down. The entry was perfect. So once you start moving down and you drop, you just trail your stops on the way down and let it ride. Or until you either to your price targets hit, which in that case would have been the 294 level, is a solid support level. You know, I was able to on NQ reverse it there when that, you know, both SPY and NQ hit their, get a little bounce, and then I reverse back short before the close. But all right, so that's just kind of a trading tip of how to use different time frames, especially when they align, when the charts align. And Okay, we're almost done here. And then after that, posting that was in the trading room, because gold day trading ops, more frequent updates come in the trading room for gold members. And then shortly after that, I posted that all three were back testing the trend lines, made it very clear that you want to see rejection off those trend lines. It would be bullish. That was, while the odds, said why the odds, could prove that yesterday's breakdown was a whipsaw signal. They may not be. And as I said, from a pure TA perspective, I can say that shorting a backtest of a recently broken up trend line with a stop somewhat above is certainly objective. And here are those charts. Boom, there's the backtest. You can zoom in, see at that point in time, it's about as good as it gets in TA. So we'll see what happens, and this is what has to happen. This is, again, these charts where that was earlier today. That was 10:50 this morning. You can see down in the lower left corner, had us going down here, which we did, and that's where we closed right there. There's XLK, QQQ, all did the same thing. So the arrows indicate a reaction. Now if we don't bounce tomorrow, that's even more bearish. We don't get a reaction. We technically had a reaction because we did bounce. We did bounce on the lows today on SPY, if you recall. As I just showed you, we bounced off. We hit 294 and then had a minor bounce. So there is a reaction. How far it goes, I don't know. That's just a arrow. But this is where I think we go if we break that. That 294 with conviction tomorrow. So we'll leave it there. Just look out tomorrow for, like I said, those levels. We're either going to hold them, and if so, a lot of talking I just did that means nothing. If we don't break those supports, get the next sell signals. The breakouts are still intact on the S&P 500, but I wouldn't spend so much time talking about it if I didn't think it. Again, it's priced into the charts. It's the charts that indicate whether we, that correction is now started and we're going to go lower from here, or whether the market's going to kick up, hold 294, bounce, and go a little higher. That's yet to be seen. Final note, if you're on the YouTube channel, this was the video I did at that time during the day, intraday stock market analysis. It was put out during the day, and I covered the VIX, TVIX, and things. That was for members, but you guys can see that now on the YouTube channel. You just wouldn't have gotten a notification because that's premium content during the day. I'll do on the YouTube channel end of day market analysis. And then one thing I covered in that video, I want to just show you real quick, and then wrap this up because this is important too. At the time, that video, and the time we were back testing, I pointed that out here, and this can't see it here, and this was a gold knop, and a lot of people, myself, got in. Were able to get into the VIX today. Some people already had positions, but this was a beautiful entry on the VIX because when I did that video, if you check it out, we were back testing right here. This is today's candle, and so it was red at that time. So in other words, this was the pop yesterday, thanks to Powell, the Powell pop we'll call it. Then the market rallied hard and we pulled back all the way down here. So from low to high, the VIX rallied about 42%. So TVIX, VXX, any of those. And what I had said, and this is another takeaway from trading, and something I've learned, if you're going to trade the VIX, always align your trade, your entries and exits with the broad markets. In other words, if you see a technical pattern like this downtrend line I have here on the VIX, and it was here in advance before the breakout even happened, if you're going to align your, you tried to take a breakout on that, you want to make sure the stock market's broken down, because let's just say the VIX broke out yesterday like this, but the S&P 500 and NASDAQ 100, they never broke those trend lines, and what would happen? That would likely prove to be a whipsaw signal or failed breakout. But because both confirmed, and it's not by coincidence, I can tell you the VIX is not a perfect mirror index of the markets, but it usually does have some type of pattern more recently. And in this case, we have divergence and everything else, positive divergence, just like the stock market had negative divergence. And we had a clear, unmistakable, impulsive breakout yesterday when the stock market broke those uptrend lines. And then today we back tested at the same exact time the stock market back tested the rising wedges. This one back tested this downtrend line, and then boom, that's all she wrote. So there was a, even for just a quick trade, it popped right up, again, this is a level I've had on this chart for a long time. This is not just random coincidence. I've created that line back in 2018. That's a target, a resistance level, and we hit it almost to the penny today. So, you know, if you're a VIX trader, now that's the actual VIX. You can't trade the VIX itself. Trade VXX or TVIX or any of those, or futures or options on it. So, like I said, all of it's starting to line up. The VIX is now confirming what I'm seeing on the stock market. The VIX just broke downtrend line support, just like it did back here. Yes, so you can see there's an example I'm talking about. That downtrend line on the VIX and the breakout coincided perfectly with the uptrend line that I had been tracking on the SPY, QQQ, and XLK. The breakout in the VIX came on the same day the breakout on the markets did, so not by coincidence. And then, you know, VIX bottomed when the market bottomed back here. And just like now, you had positive divergence back then. So like I said, there's a lot of stuff in the charts. I may be proven wrong, but you know, again, if it doesn't happen now, it can happen a week, 2 weeks. Like I said, don't fall asleep at the wheel. Volatility was low up until recently. It's finally expanding. The market's waking up, and that's usually when the correction starts. So a little more work to be done, like on the markets as well as VIX. VIX needs to pop today's highs. Market needs to pop today's lows with conviction. It's that simple. Let's just leave it at that. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.